The market sure thinks the Fed is done. Nick Timmeros of the Wall Street Journal published about an hour ago that says summer break appears likely as officials monitor effects of banking stress, while the inflation report reinforces the Fed's plans to pause. You think we're wrong?
Well, I don't think that the inflation report actually does reinforce that the Fed should stop raising rates. That it's true that the headline rate was just a little bit lower than expected, but the core rate came in exactly where it was expected, and in fact is still at a very high level. It hasn't really fallen very much. So, given that, plus a very strong labor report that we just had, the Fed basically cannot declare victory. That inflation is still a real problem. There's no clear-cut evidence that, in fact, inflation is coming down towards the 2% target over a reasonable horizon. So the Fed, I think, potentially has to raise rates. But even more importantly, there's no way the Fed should think about pivoting for a very long time. Very key is that the rates be kept high for a long time, unless, and here's the wild card is the banking sector. If there really are some problems in the banking sector and lending stops, that's a whole new ballgame, and then we could be in a very different environment. However, the Fed has much more information on that than we do, because they're actually supervising those banks. They can see whether, in fact, there's a problem. And so far, the rhetoric coming from the Fed is that things look like they're pretty contained on the banking side. If that's the case, they could even have to keep raising rates, but certainly for a very long period of time. And I've been saying this for quite a while, that the Fed had to raise rates and keep them high and not make the mistake of starting to lower them too early. That would be a very, very problematic move for the Fed.
I know, but we already know from the senior loan officer survey of just a few days ago that credit is tightening, that loan demand is declining. Austin Goolsbee, Chicago Fed, himself said he's getting, quote, vibes of a credit crunch. You're not moved by any of that?
Yeah, I think that there is some issue that there's some slowing. The question is how much. If in fact, the banking problems had not occurred, surely the Fed would have to raise rates at least another 50 basis points. So that's why my view is that the fact that there has been some tightening in credit markets is one of the reasons the Fed is not clear that they have to raise that much. But there's no indication that basically that inflation is contained. Core inflation that takes out these volatile items that don't tell you about trend inflation and what the future of inflation might be, that's still pretty damn high. And that's the problem for the Fed. They're not happy about this. They'd love to see inflation come down faster. Nobody likes higher interest rates. The Fed doesn't like them. They don't want to do them. But in fact, if they don't have high interest rates to contain inflation, then you'll have higher rates, even higher rates in the future. So, they have to do their business and stick to their guns and do the right thing. And it's not always easy to do that. But, you got to be a tough SOB sometimes.